Look, for the past 2 years, skeptics have been asking the same question about AI. Where's the actual money, like real revenue, real profits? Not just burning billions on GPUs and calling it innovation. Well, a company that might go under your radar if you're not from the tech or data business just answered that question. And the stock jumped over 20% after hours for a reason nobody's really talking about. Okay, if you're short on time or you're thinking, why should I listen to some random guy with a cat avatar? Fair enough. Here's the single most important thing you need to know. MongoDB's latest earnings prove that AI isn't just hype anymore. Companies are literally ripping out their old databases and replacing them because AI broke their systems. And when I say broke, I mean these companies had no choice. The pain of staying was worse than the pain of a complete replatform. It's not just a pilot project, but a structural change instead. And that's real money flowing. Hey, I'm DataCat. Yeah, I know cat avatar finance content. Trust me, the irony isn't lost on me. But here's the thing. Cats are survivors. We land on our feet. And after spending years as an analyst inside a Fortune 50 company, who also happened to hear my colleagues arguing about which database is more suitable for our use case on a day-to-day basis, today's video is a bit special. Deja vu, really. Oh, and this channel's about 4 months old now. I'm not here to brag or pretend I've got all the answers. But I spent enough time to know what matters and what's just noise. And right now, there's something happening in the enterprise software space that Wall Street analysts are either missing or deliberately downplaying. If you are into this kind of analysis, please subscribe to this channel to let my cat know I have not gone mad. So today, we're talking about MongoDB's latest earnings. Now, hold on, I know what you're thinking. A database company? Really? That's what I clicked for? So this is just a clickbait video? Please stay with me, because unlike most AI stocks where you're supposed to just trust the vision and ignore the losses, MongoDB just showed us the receipts. Real architectural changes, real migrations, real profitability, and which is kinda rare recently. So let's set the stage. For the last 2 years, we've been living in this weird tension, right? On one hand, every single company, doesn't matter if they sell software, sneakers, or sandwiches, every earnings call starts with, we're investing heavily in AI. It's like a corporate game of follow the leader, except nobody knows where we're going. But here's the problem. Where's the monetization? Like, actually show me the money. Most AI stories fall into 3 buckets. First, you've got R&D spend. Companies are burning billions training models, buying GPU clusters, basically playing a very expensive game of computational roulette. Second, early stage pilots. You know, the classic, we're experimenting with AI agents in 3 departments. Cool. Are they generating revenue? Well, not yet, but the potential. Third, growth narratives with 0 profit visibility. Our AI product will disrupt everything. Okay, but when does it make money? Soon. Maybe. Probably. Just trust us. And look, I get it. New technology takes time to mature, but investors aren't exactly patient creatures. We're like cats waiting for dinner. After a while, we start knocking things off tables just to see what happens. The skeptic's question was this. Show me where AI actually causes companies to spend material money, change their operations, and produce returns. Not burn cash on experiments, not promises. Show me the P&L impact. And MongoDB's third quarter earnings call. That's the answer. And honestly, it's one of the clearest ones we've gotten so far. Alright, so here's what MongoDB's earnings revealed. And this is way more important than whatever the headline revenue number was. They showed us a repeatable pattern. Companies are being forced to migrate their data infrastructure because AI workloads broke their old systems. Not inconvenienced. Broke. Now I'm going to explain the technical side, but I promise I'll keep it simple. The point isn't to bore you with database architecture, it's to show you why this is proof of a fundamental shift. MongoDB's new CEO said something really basic but cut through all the noise. He said, AI applications must connect what LLMs know with what companies know, their proprietary data, systems, and real-time context. This is fundamentally an information retrieval problem, and it requires a very different architecture than the last generation of software. Translation: AI needs a different kind of database. Think about it. AI applications need to handle documents, logs, images, events, messy, unstructured stuff. They need to change their data structure rapidly as AI models learn new things. They need something called vector embeddings for semantic search, basically finding meaning, not just keywords. And they need all of this in real time with low latency, because nobody's going to use an AI assistant that takes minutes to respond. Now compare that to what legacy databases like Postgres were built for. Rigid tables, structured data, SQL queries, schema changes that require migrations and slow everything down. And if you want to bolt on AI features, good luck. You end up with this Frankenstein architecture. Postgres for your data, Pinecone for vectors, separate services for embeddings. It's like trying to make a cat and a dog share a litter box. Technically possible, but messy and nobody's happy. So what happens when companies move AI from prototype, we're talking about from small data, toy models, to production, real scale and latest models? The old infrastructure breaks, latency spikes, costs explode, development grinds to a halt, and at that point companies face a choice. Keep hacking workarounds onto Postgres or re-platform onto integrated AI-native infrastructure. MongoDB's quarter proves that enterprises are choosing the second option, and that choice is showing up in their revenue. Real revenue, profitable revenue. Now let me show you the evidence, because unlike a cat knocking over a vase and walking away, we need to prove causation here. The CEO shared this example on the earnings call. He said, "There is a really good fast growth at scale AI native company that currently switched from Postgres to MongoDB because Postgres could not just scale." Okay, pause. Why does this matter? First, we need to acknowledge that ripping out Postgres from a running production system is expensive, risky, and time-consuming. You're rewriting queries, migrating data, retraining teams. Companies only do this when the pain of staying exceeds the pain of migration. That's a high bar. That's desperation. Second, the trigger is explicitly AI scale. They didn't migrate for general performance reasons. They migrated because Postgres couldn't handle AI workload characteristics. That establishes clear causality. AI adoption led to database inadequacy, which forced migration, which created MongoDB revenue. Third, the customer is at scale and fast growth. This isn't a startup burning venture capital on experiments. This is a material business with real users and revenue. The migration happened because the AI workload was successful enough to stress Postgres. That means MongoDB's revenue is now tied to this customer's AI-driven growth. And fourth, this is important. The company moved everything to MongoDB, operational database, embeddings, vector search. That creates deep technical lock-in and multiple revenue streams that all scale with AI usage. This is exactly the kind of structural demand signal the market needs to see. AI isn't just adding features. AI is forcing companies to replace core infrastructure. Those replacements are deliberate, expensive, sticky, and long-term. That's a land and expand motion driven purely by AI requirements. Each step increases MongoDB's revenue surface area, and it's repeatable. Now let me give you another example. A highly influential global media company with over 70 websites. They were using Elasticsearch to power content recommendations. Pretty standard setup. But then they hit a wall. Elastic couldn't handle the complexity of new embedding models. The system became a bottleneck. And they realized their rigid architecture was stifling innovation. Which, in media, if you can't innovate on recommendations, you're basically dead in the water. So they re-architected on MongoDB Atlas, Atlas Vector Search, and Voyage AI embeddings. Proof of concept took weeks, not months. The results? 90% latency reduction, 65% operational cost savings, 35% increase in click-through rates. Now this is proof of profitability. Why? Because it's better and cheaper. The AI native architecture is simultaneously higher performance and lower cost. This destroys the narrative that AI is inherently expensive and low ROI. Companies can walk into the CFO's office and show both revenue lift and cost reduction. That's how you get budget approved. That's how you get migrations greenlit. Also consolidation. The old way was operational database plus Elasticsearch plus separate vector database plus ML tooling. 4 vendors, 4 contracts, 4 things to learn and manage. The new way, 1 vendor, simpler operations, faster iteration. And once this consolidation happens, it's extremely sticky. Nobody rebuilds their recommendation stack every year. We're not dogs chasing squirrels. We're cats. We find a comfortable spot and we stay there until someone moves our food bowl. Okay, so now let's connect all the threads and answer the core question. How does this prove AI is driving profitability? First, real architectural shifts require real budget. Migrations from Postgres and Elasticsearch aren't trivial. They take quarters, not weeks. They cost engineering time, data migration costs, application rewrites, operational risk. Companies only authorize this when AI is strategically critical, ROI is demonstrable, and existing systems are blocking value creation. Every migration is evidence that AI is material enough to justify expensive infrastructure changes. Second, operating leverage is improving, not deteriorating. MongoDB's operating margin is 20%, expanding from 19% year over year. Free cash flow is $140 million, up 4 times year over year. And this is happening while they're investing in engineering, sales, and marketing. The revenue growth isn't being bought with unsustainable unit economics. As Atlas scales, gross margins improve. The business model gets stronger as it grows. Third, net ARR expansion is 120%. That means the average customer increases spending by 20% year over year. Why? They're adding new AI workloads, modernizing existing systems, and their AI inference scale is growing. This isn't a land grab where customers churn after initial projects. It's a platform play where customers expand usage over time. That's the hallmark of durable, profitable software. And fourth, the CEO kept emphasizing that enterprises are still mostly in pilots. True agentic AI at scale hasn't hit yet. We're still early. Yet MongoDB is already showing accelerating growth, expanding margins, and surging cash flow. So if the current numbers reflect the pre-AI baseline, the upside from full-scale AI agent deployment could be Well, let's just say substantial, and MongoDB is positioned to capture it with existing customer relationships and technology already in production. So what does MongoDB's quarter mean for the broader AI investment thesis? 3 things. First, AI infrastructure is monetizable today. The narrative that AI is just capex with no revenue path, MongoDB's results contradict that. This validates investing in the picks and shovels layer, not just the model and chip companies. Second, enterprise AI adoption is real, not vaporware. Fortune 500 companies are migrating databases, changing architectures, and allocating serious budgets. The AI spend is hitting enterprise P&Ls in measurable ways. Third, profitability and growth can coexist. The old dichotomy was growth companies burn cash and lose money, or profitable companies have slow growth and optimized margins. MongoDB is showing a third path, accelerating growth, expanding margins, and surging cash all at once. This is what durable, efficient growth actually looks like. Look, for 2 years the market, including myself, has been debating whether AI would be a massive capital sink with distant payoffs or a transformative technology driving real business value and profitable growth. But MongoDB's results just provide clear evidence for the second option. Real migrations, real revenue, real profitability, and real business outcomes. The 20% plus stock surge, that's the market recognizing this isn't just another beat and raise. It's proof that AI is entering a monetization and profitability phase. Infrastructure providers can build durable, high-margin businesses on top of AI workload growth. And honestly, as someone who spent years watching budget cycles and infrastructure decisions, this is the kind of evidence I like. Not promises, not pilots, actual proof. Anyway, that's it. If you found this valuable, please help smash that like and subscribe button to support this tiny channel. If you think I'm wrong, definitely let me know. I'm still figuring this out like everyone else. I'm just a cat with a spreadsheet trying to land on my feet. That's it for today. DataCat out, and I'll see you in the next one.